A forgotten strategy made Buffett 29% per year in his early days, but he stopped using it when Charlie Munger and one other notable figure changed his mind. What does this strategy entail and how to use it in today's market? Does it still work? I will go in depth now and share all my 13 years of investing experience and knowledge on the topic. Before Warren Buffett became the global symbol of quality investing, before Berkshire Hathaway acquired its first insurance company, and long before he was known for buying wonderful businesses at fair prices, he practiced a highly mechanical, deeply contrarian, and now largely forgotten strategy known as net investing. This approach, lifted directly from Benjamin Graham's playbook, formed the foundation of Buffett's early career and produced extraordinary returns. But it was a strategy he later abandoned as his thinking evolved under the influence of Philip Fisher and Charlie Munger. Understanding this evolution is essential to understanding Buffett's entire philosophy. What is net investing? Net investing comes from Benjamin Graham's concept of the net current asset value, NCAV, a method designed to buy companies so cheap that they were worth more dead than alive. The formula is simple: net value equals current assets minus total liabilities. Graham advised buying stocks trading for less than 2/3 of this liquidation value, an extreme level of undervaluation. These were companies where cash plus account receivables plus inventory were worth more than the total liabilities plus the stock price. The business itself, plants, brands, intellectual property, future earnings, was valued at zero. Nets were often failing companies, deeply unloved in boring or dying industries, but the margin of safety was enormous. A margin of safety is a term coined again by Ben Graham, and it is a risk management technique. An investment has a bigger margin of safety if you buy it much lower than its underlying value. Even without operational improvement, the stock price of a lot of these net stocks could rise dramatically just by reverting toward liquidation value. This was the first concept of value investing in its most mathematical, statistical, and emotionless form. Later on, it evolved, but I will explain this evolution in just a few minutes. First, let's understand how Buffett used net investing in his early career. When Buffett returned to Omaha in the mid-1950s to start his partnerships, he applied Graham's net approach rigorously. He scoured Moody's manuals and annual reports for obscure microcaps trading below liquidation value. He frequently bought dozens of these companies at once, spreading risk across many positions. A high degree of diversification was applied when using this method. Most of the time, between 30 to 100 stocks were bought. Later on, Buffett switched his views on diversification, calling it diversification. While Charlie Munger said, "You don't mitigate risk by buying a lot of stocks, you buy the right stocks," meaning that the real value investor has to mitigate his risk with a proper stock assessment and analysis. Buying fewer great stocks increases your returns more when compared to buying a lot of subpar stocks. During the 1950s, Buffett's investments were often tiny, illiquid, and unknown. He described these as cigar butts, stocks with one last puff of value left. He didn't need growth or quality, just extreme cheapness. Examples from his early partnership letters show Buffett buying small banks with excess cash, distressed textile companies, neglected retail chains, minor industrial firms with inflated net current assets. The results were astonishing. Buffett achieved roughly 29% annualized returns in the partnership era from 1956 to 1969, with many of his biggest winners coming from deep value nets. I made a full in-depth description of the net strategy. You can grab a free PDF copy from description. I will also share it as a pinned comment. It's quite useful information for every serious investor. At the time, this was entirely rational. Buffett had limited capital, a small partnership structure, and access to a universe of overlooked stocks. In other words, he practiced the pure Graham discipline, and it worked beautifully. Most people think that net investing is a relic from the past, but this is not correct. One man used this strategy up to the new millennia, and it has given him outsized returns for over 45 years. His name is Walter Schloss. He was the purest Graham disciple who beat the market for decades. If Buffett was Graham's most famous student, Walter Schloss was his most faithful. Schloss worked with Graham at the Graham-Newman Corporation and never abandoned the net philosophy. Unlike Buffett, who later evolved toward quality investing, Schloss maintained the same simple formula for more than 45 years. Schloss's approach included no contact with management, no forecasts, no macroeconomic views, no detailed competitive analysis, buying 50 to 100 deeply undervalued stocks, rebalancing as the discount narrowed, so when the price went closer to the liquidation value, Schloss would sell. He used only 3 key data points: price relative to book value, balance sheet strength, insider buying, and financial conservatism. Despite the simplicity, and partly because of it, Schloss compounded capital at roughly 15 to 16% annually from 1955 to the late 1990s, one of the greatest long-term track records ever recorded. Buffett said of Schloss, "He knows how to pick stocks and he has total integrity. He has a good sense of value. He's not worried about missing something or what people think. He just goes about his business." Schloss proved that net and deep value investing can work indefinitely if one is patient, disciplined, and emotionally steady. Nowadays, there are still such investment opportunities, but most of them are in markets like Japan or other emerging markets. To find such quality nets in the USA, Canada, or Europe has become a challenge, but our team of analysts manages to scour the globe for such investment opportunities, and in future videos I will most likely share some of them. So don't forget to subscribe so you don't miss out any valuable information. Buffett absorbed net investing directly from Graham while studying at Columbia University. Graham's textbook, Security Analysis, was his Bible, and Graham's insistence on buying $1 of value for 50 cents shaped young Buffett's worldview. The core lessons Buffett internalized were: markets frequently misprice assets, which is due to the fact that market participants are human beings with emotions of fear and greed. The following lesson was to always be buying below liquidation value creates a margin of safety. Graham taught Buffett that mechanical discipline outperforms emotional decision-making. He also learned to avoid forecasting, rely on facts, and during that time, Buffett's goal was to diversify widely in deep value situations. Buffett's early success came from strict adherence to these principles. He was so devoted to Graham's teachings that he once said, "I am 85% Benjamin Graham." But this began to change in the early 1960s when Buffett encountered two thinkers who transformed his philosophy: Philip Fisher and Charlie Munger. Philip Fisher, author of Common Stocks and Uncommon Profits, argued that the best investments were high-quality growth companies. Intangible factors like management quality, innovation, reinvestment opportunities mattered. He spoke that a great company bought at a fair price could outperform a statistically cheap company. Fisher taught that a business is worth far more than its current assets and liabilities. Buffett realized that a company with durable competitive advantages and high returns on capital could compound value for decades. This challenged and eventually transformed his Graham-based mindset. If Fisher cracked open the door to quality investing, Charlie Munger kicked it wide open. He argued forcefully that it's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. He convinced Buffett that great businesses require less monitoring, that high ROIC and long reinvestment runways outperform statistical cheapness. He transformed Buffett's highly diversified style of investing into a concentrated portfolio. Concentration in quality beats diversification in mediocrity, while also teaching him that a high degree of diversification is for investors who do not know what they are doing. When you have a lack of knowledge, you buy a lot of stocks. When you have clear and precise knowledge, you buy a few great stocks. Munger changed the way of thinking in which value means cheapness. Growth is not the opposite of value. Growth is part of value. Munger famously pushed Buffett to move away from cigar butt investing toward buying compounding machines. This switch ultimately allowed Buffett to scale his operations into the trillions of assets under management. Buffett gradually stopped using the net method during the mid-1960s. 3 primary reasons drove the shift. The first problem, which was constraining this model, is the capital size constraint. Nets are usually tiny, illiquid, and overlooked. As Buffett's capital base grew, the strategy became impossible to scale. Berkshire's tens of billions and later hundreds of billions could not be deployed into microcap cigar butts. Another reason for the shift was the realization that quality outperforms cheapness over long horizons. Buffett concluded that nets offer a one-time revaluation, which are the liquidation discount closes. Quality businesses offer exponential growth, which is the effect of compounding. Einstein called it the 8th wonder of the world. A revaluation might give a 20 to a 100% return. A quality business might give a 1000% return. The third reason for the shift was also a realization that great businesses are easier to own. Buffett and Munger preferred predictable cash flows, moats like economies of scale, brand, network effects, etc. Watch my video on moats here on the channel. They prefer durable pricing power. Compounding reinvestment is something they also want to see. And of course, strong management. Net-nets offered none of these. Thus, by the late 1960s, Buffett officially moved away from pure Graham-style deep value. The turning point came with his investment in See's Candy, a high-quality business with immense pricing power. See's taught Buffett that intangible assets like brand and customer loyalty could be far more valuable than assets on a balance sheet. He later said, "See's Candy changed my life." It was the symbolic end of net-net investing for Buffett. I want to discuss why Buffett's evolution was rational, but Walter Schloss's persistence also worked. Some investors wonder how Schloss continued to succeed with net-nets while Buffett abandoned them. The explanation is simple. Buffett's capital base grew to a scale where net-nets were no longer feasible. Warren's capital was enlarged even more when he started acquiring insurance business and using the float, which is a revolution in the industry which was perfected by him. Watch my other video here on the channel about how Buffett used insurance to conquer the world of investing. Schloss stayed small and nimble, allowing him to exploit deep inefficiencies forever. Both were rational within their constraints. At the end of his career, Walter Schloss managed around $100 million and was a one-man show in a tiny office. He just scoured the markets for deep value stocks, trading for the cash levels of the business. This worked until the 1990s and it still works today. Here is a good moment to remind you to grab a free downloadable document with the full net strategy from the link in the description. You can also grab a free copy from the pinned comment. In general, Buffett evolved not because the net strategy stopped working, but because it stopped working for him at his size. Net investing was the fertile soil from which Buffett's philosophy grew. It taught him discipline, margin of safety, and the reality of market inefficiency. Walter Schloss proved that the method can outperform for a lifetime if practiced consistently and at a manageable scale. But as Buffett's circle of competence and influence expanded through Philip Fisher's vision of quality and Charlie Munger's philosophy of wonderful businesses, the net strategy became too small a tool for too large an investor. Buffett evolved from dumpster diving for cheap stocks to identifying some of the best businesses in the world, yet he never disowned his roots. In his own words, "I'm glad I learned the Graham approach. It worked. It taught me to think. But Charlie pushed me in the direction of better businesses, and that made all the difference." Net built Buffett. Modes made him legendary. Subscribe for more high-quality investing content. I'm reading also all the comments and I thank you.